Let's get into lesson 5, the overview of the put path options trading system. So far, we've gone over in the course the basics of options. We've gone over risks. We've gone over how to set up a put credit spread. Now we're going to get into the specifics on the put path. So the put path is a term that we coined that outlines our trading methodology. This is a rules-based system. It's going to help beginner traders or experienced traders that are looking for a more consistent system. It also has the advantage that it only takes 15 minutes per week. So you have minimal time investment. It's a structured system. You can systematically manage these trades. You're going to leverage your probabilities. You're going to rely on theta decay, and you can build confidence with a repeatable system. So what exactly is the put path options trading system? We're going to get into the strategy. What we're looking to do is to sell these put credit spreads so that we have downside risk protection. We know our max loss. We have highly liquid index and commodity and other assets that we're trading. We're focused on high probability setups, 85% probability of profit. We allow time decay to work. We trade typically during the week where there's a 1% down move in the underlying. What that does is it allows volatility to spike, gives us a good entry point. And this is designed for consistency over time. It's designed to have a high volume of trades, 12 per week, which adds up quickly over time. So you get the occurrences where you're putting the probabilities in your favor and the law of large numbers starts to work, and you see that you'll be getting 85% probability of profit and win rate. So why do we use this system? Why do we use the put path? It's because of all the benefits listed above, and really it's been a system that I've been tweaking since 2020. It's been remarkably consistent. It works in bullish markets, in neutral markets, and even in some bearish scenarios where you don't have your strike price that's breached. So it's very consistent. It's very low stress, very easy to execute with minimal time commitment. Our positions are far out of the money. We shoot for the 15 delta, which basically means there's a 15% chance that you'll lose on the trade. Positioning the strike price far away from the current market price. What that allows you to do is to benefit in the majority of market conditions up to 1 standard deviation of normal price fluctuations. We let the normal curve work in our favor. We let the probabilities work in our favor. I've got a statistics background and engineering background and math background, and that comes in handy when you're trying to conceptualize these probabilities and these entry points and exit points. A lot of traders play around with the 50 delta or at the money position. We opt to go far out of the money. We choose a minus 0.15 delta, which gives us that 85% probability of profit. The closer that you get to the money, it's true that you will have a higher premium collected. However, with our positions, we have a high confidence that they're going to remain out of the money. So we have lower stress and we don't fight the market. We allow the market to go on normal fluctuations up and down. As long as we don't have our strike price breached, we remain in good shape. There's a song by the Rolling Stones, and it says, "Time is on my side." And that is for sure what we look for with options trading. We use the advantage of theta decay, which is your time decay, which is the major component of the extrinsic value in these options. Since we're way out of the money, we just allow the normal market fluctuations to occur. We don't need the market to do anything. We're playing the waiting game. So as these options move towards expiration, the theta decay or the time decay increases. The trader on the other end starts running out of time for the trade to go in their favor. So we let the time work for us. We benefit from a steady, predictable decay, and we are not as concerned about price sensitivity since our options are so far out of the money and we don't have to worry about gamma risk. So we're going to get into the Greeks in detail in an advanced lesson, but for now, I wanted to hit on really theta, delta, and gamma. So delta is your rate of change, and then gamma is a second order derivative based on delta. So gamma is your rate that delta is shifting. So for theta, again, it's measuring time decay. That's your daily erosion. That's what we use as the bread and butter to make money. The gamma risk comes into play really when the option gets closer to the money, especially at expiration, right before expiration. If the option's close to in the money, then it can go either way, in the money or out of the money. So the gamma has an outsized risk in these small moves. So we balance both. We keep our trades well out of the money. We look at a 28 to 32 day to expiration. We make sure that we are closing the trade early if possible. We put in a 2-cent debit so that we don't try to squeeze out that last 1 or 2 cents, but we close the trade almost at max value. We get that capital back, and we also avoid any assignment risk and gamma risk at the very end of the trade. Let's get into volatility and put skew. So downside puts trade at a higher implied volatility than upside calls. Therefore, our premium is going to be higher on these downside puts. The simple explanation for that is the fear premium. So the market is scared of quick downside moves in these underlyings. And if that's the case for the particular underlying, you're going to get put skew, which is going to benefit you as the put seller. So selling puts when implied volatility is high actually improves your expected returns. So what we do is we wait for a 1% down move in the underlying during the week, and we put on a new put credit spread. That's what's going to give you the best percentage chance of profitability going forward. And what we've seen is historical volatility actually comes in less than the implied volatility. So what that means is the volatility that the market expected is your implied volatility. What actually happens is your historical volatility, which is less. And that's the edge in the whole system, is that the stock or the underlying does not historically move as much as the market is expecting, which benefits you as the seller. So again, with put skew, you're going to see volatility increase as you get farther away from the strike price. So you can see the graphic here, you get a little smirk, and that's your put skew as an example. And then when you're comparing it to an equidistant call on the high side, you're also going to have about a 5-to-1 advantage typically in the range that we're talking about at the 15 delta. So your pricing and your premium that you collect is going to be about 5 times higher if you sell the put versus selling the call. So this just shows how the elevated IV is going to help you with pricing as you move farther away from the current underlying price. How do we manage our trades? How do we open trades? How do we close trades? What are our rules for managing? So we have predefined entry criteria, and we're going to go over all of that. We talk about the underlying, the days to expiration, the delta, the strike price, and the lot sizes. So those are the rules. We have our profit targets, where we're going to try to get a specific credit on a specific underlying. We close the trade at a 2-cent debit or a 200% stop loss that is triggered by a self-imposed monitoring of the trade, or a bracket order if you have Tasty Trade or another type of brokerage that'll do a bracket order on the low side as well as the high side for winning. And then we have our loss management, which is going to improve your consistency. So we make sure that we stick with that 200% self-imposed stop loss. We take the trades off as quickly as we can with the 2-cent debit so that we can recoup that capital. We don't want to be at the end of the trade where we can have a position that is close to the strike price, where you have a gamma situation that can go against you very quickly if you're close to that at the money position. This slide really summarizes the system nicely. So this tells you exactly how we do these trades, when you enter the trade, how you enter the trade. So what we look for is a qualifying setup, meaning it meets all of our criteria in terms of underlying the delta, the DTE, the width of the spread, and the size. You confirm that you meet all the requirements. And then the win is during the week, Monday through Thursday, you look for an opening in a high volatility environment, or when that particular underlying has decreased 1% or more. That's going to tell you a good entry point. Then you monitor the position, not obsessively, but you're looking at these positions. You're going to put in a bracket order or a 2-cent debit order, depending on what your brokerage allows. You're going to watch for price movement. You're going to look at the percentage that your position has gained or lost. If it gets close to that 200%, you're either going to have an automatic stop loss that your brokerage can execute, or you're going to have to put in a manual order to get that trade closed at the 200%. The 2-cent debit should be easy enough. Every brokerage is going to allow you to put in a closing order for 1 cent, 2 cent. What that's going to allow you to do is to recoup that capital. From there, you're going to rinse and repeat. You're going to be disciplined, you're going to be consistent, and you're going to not try to predict the market, but put your trades at that 15 delta so that you can win consistently in many different types of markets and many different scenarios for that particular underlying. As long as you don't breach that strike price, then your trade is going to be a full winner. That's the foundation, and that's the key to long-term success. I'm just going to expound on a couple key concepts here. So in order to limit your risk, you're going to want to do a couple things every time. You want your lot sizing to be as small as possible. What we recommend is that you trade in 1 lots first across all 12 underlyings so that you diversify and spread that risk. And that's much more effective than having 1 underlying and trading in a 12 lot, for example. We diversify our trade expirations by setting them up so that one rolls on each week and one rolls off each week, and that's going to diversify your expiration dates. We have 12 underlyings. Some of them are non-correlated. That helps you diversify your assets. We close trades at that 200% max loss. That's going to preserve your capital and avoid the sharp drawdowns which kill your account. Discipline during volatility is key to maintain your capital. Many people struggle to close trades. They're fighting the market, they're fighting the trade. A lot of that is because I believe they're emotionally attached to the trade. They may have done an hour of research on the Bollinger Bands and the support levels and resistance levels. They know what they thought was a good entry point and a good exit point. They put all this research into it, and they were wrong. So it's kind of hard for them to let go of the trade. For me, losses are an expected part of trading. I'm expecting to lose 15% of the time. So I don't get emotionally attached. I go ahead and close these out at the 200% stop loss limit. I make sure that I don't have those major losses that are going to draw down your account. Remember, you don't want to be fighting the market. You want to go with what the market's giving you, trade what's in front of you. Remember that you win in 3 scenarios. When the stock goes up, you win. When the underlying stays the same, you win. And even when it goes down marginally, you still win. Okay, just a quick review of some key concepts. So what are we doing here? We're selling downside risk. We're taking on that risk of selling a put credit spread. We do that in index products. We do it in highly liquid products that are defined risk. We're using probability, not prediction. We don't necessarily have a market outlook on each of these underlyings. What we're doing is we're selling these far out of the money at the 15 delta, positioned far away from the current price of the underlying. We're leveraging time decay. We're letting theta do its work. That's your time decay extrinsic value of the option. We're selling these at 28 to 32 DTE so that we can capture that steady, reliable theta decay. And we're using our put skew edge. So we're taking advantage of the pricing advantage that we get with the puts. The put path works for everybody, but it's really designed for beginners. I think beginners are really suited for this system because you haven't developed any bad habits yet. You don't know what you don't know, and you kind of accept some things without having to be retrained and get out of your bad habits. But that being to the side, this system is designed really for anybody who's a busy professional that's looking for a more consistent, time-efficient strategy. You should be able to trade this system in 15 minutes or less per week. You should be able to execute the trades, put in your closing orders in that allotted time. It's systematic, it's rules-based, it removes the guesswork from your decisions, and we're relying on probability, we're relying on math, we're relying on the market to do what it's set up to do. Here's a couple of myths that we're going to debunk. Biggest myth is a lot of options traders try to predict direction. They want to predict the direction of the underlying within allotted time. It's almost impossible. It's a coin flip at best. Even with all the indicators and all of the algorithms that are out there, it's really challenging to predict how much a stock's going to move within an allotted time. That's why we rely on the deltas. That's why we rely on the probabilities, and we take advantage of that over time. Another myth is that naked options are the best strategy. A lot of people, they trade cash secured puts, they trade strangles, and those are great if you have a huge account size and you really know what you're doing. However, for the most amount of traders, the large majority, they can't support that amount of capital, and they have to use spreads to limit their buying power reduction and have a chance of making a good profit. The third myth that I hear a lot is that options trading is too complex, particularly for beginners. So that's why we put together all of these definitions. We put together the basics, we put together the risks. We're going to get into the advanced concepts. I have a step-by-step system. It's marked out like a path that you can follow. It is consistent, it is logical, and it's something that you can implement rather quickly after you understand the basic concepts. So I'm trying to simplify all of that for you. How do you get started? So getting started really comes with confidence. It comes from a place of understanding what you're doing. So what we're walking through here is the basics. Obviously, you need to understand how puts set up, how credit spreads set up. You need to understand the Greeks, delta, theta, gamma. Those are the ones that we really focus on. And then I encourage you to practice on paper. You can use your brokerage. A lot of brokerages have ways that you can paper trade for a while, making sure that you understand what you're doing, giving yourself that confidence through repetition. And then once you start to do it, start small. Go with one lots, go with one underlying. Then as your Discipline increases. As your confidence increases, then scale up. I just want to set some expectations. This is not going to be easy. Anybody who tells you that options trading is easy and that they found the secret is lying to you. But also on the flip side of that, anything that's worthwhile is worth putting in the time to learn how to do it correctly. So the quote here is, success comes from following rules, patience, and realistic expectations. So don't expect that you're going to 10x your account. We shoot for a 50% annual rate of return, which in terms of market performance against stocks is excellent. But we don't promise the moon. You have to be consistent. You have to be disciplined. You have to close your trades out when you're supposed to. What that'll allow you to do is to build confidence, to trust the probabilities, to trust what the market's giving you, and become a more seasoned trader and a more profitable trader.